In this series, we're going to be talking about how to build a successful trading plan and calculate your profit and loss ratio. Let's begin. So, what is a trading plan? It is a set of rules that you set as a trader before and throughout your trading experience to achieve consistent success as a professional trader. It's essential to have a well-defined trading plan, a risk management strategy that covers the entire trading process from pre-trading to post-trading analysis. Despite the crucial role that a trading plan plays in achieving profitable outcomes, many traders tend to overlook it. So don't. Having a successful trading plan means identifying your trading strategy, always calculate your risk reward ratio, and understanding the psychology before you start a trade. You need to be clear of mind and prepared to enjoy the trading journey. So choosing a strategy is a predetermined set of rules and guidelines that determine when to buy, sell, hold a position in the market, or hedge. Before entering the market, it's crucial to select one that aligns with the current market conditions and not going against the market. Whether the market is trending upwards or downwards or moving sideways, you need to be able to know what's the actual current trend and what are the key economic indicators that are coming out that will potentially move the markets upwards or downwards, and that will also have increased volatility on the markets and will affect your trade. It's also important to ensure the chosen strategy is well suited in market conditions to maximize the potential for profitable outcomes. And every trading strategy has its own set of strengths and weaknesses, and it must be thoroughly analyzed and understood before implementing it. And it's recommended to test the selected strategy on a demo account before applying it to a real trading account, just to minimize losses. This approach allows you guys to gain practical experience with the strategy and evaluate its performance under different market conditions. So, like I said, you all need to have a stop loss, calculate your risk return ratio, and check a lot of fixed time frames, and then check when you're going to exit the position. Now, for the first one, we're going to give you guys examples in the next slide about calculating the risk and reward ratio. And in terms of a fixed time frame, it's recommended that before you start trading or entering position that you check multiple time frames in terms of like 4-hour charts, 1 day, and the weekly, just to kind of analyze how the markets are really heading and not to be downplayed by how a chart looks like in a short time frame. So determining the percentage of risk is that one can tolerate before entering a trade is a crucial element. Always have the initial capital inside your trade. Don't go beyond the leverage that you should. And traders usually cap the risk to a specific percentage in their account balance for a single trade. Typically, ranging from 1 to 5% based on the risk appetite and loss tolerance. Obviously, if you have, if you start with $500, then your risk reward ratio will be limited, and also your leverage should be very, very small, if not at all. And then example of 2% capital management per transaction. The meaning of 2% capital management means that the largest loss you will lose in a single trade is 2%. You can adjust that to 5% based again on the capital in your account. You enter a buy or sell position with a mini contract of 1 pip. Your capital in the account is 1,000, and the maximum loss of trade must be 20 pips, which equals $20 loss. That is equivalent being or assuming that you're not trading with any leverage. This means that the maximum loss you will lose for this trade is only 2%, and this is how you go on further by assessing how much risk you can actually tolerate. So if your account loses a 2%, then you will have only $980 in the account. Now, profit and loss ratio is the value of money or percentage you risk from your account in order to get your goal. So another clearer example is your account. Let's say it's $1,000 and your capital management is 20%, which is losing $20 at a maximum. The goal of the trade is a minimum profit of $40. You want to make a profit of minimum for $40, and the expected return percentage of this trade, your target, must be higher than the expected loss. Therefore, one of the most important rules for building a trading plan is that the profit and loss ratio should not be less than 2:1, meaning 1 is the stop loss and 2 is the profit. The higher this ratio, the stronger the strategy, but if it falls 1-to-1, it entails a loss. So you need to have a greater stop loss than the profit that you assume to make, just in case you want to minimize your losses. So these are some final tips that I want to give you when you're calculating your risk and reward ratio. Is you evaluate your performance weekly if you're a new trader, and prepare your mindset to the right time to trade. Don't trade when you're super busy and you don't know what's going on in the market and you don't even know what economic indicators are going on, or what are the current market conditions. If there are speeches, if there's FOMC meetings, if there are retail sales data, all these things really affect the market. So you need to prepare your mindset for the right time to trade, and also diversify between the correlation of products, meaning instead of or let's say just diversifying something that, like, let's say we have news that is going to affect the dollar or that is going to affect gold prices, meaning you can diversify by trading a commodity plus a pair that doesn't correlate with the pair, unless obviously it has an inverse correlation, which means that they are inversely correlated, which is okay. Don't challenge the market. If you see that the trend is going up, obviously buying here would be okay, but then if the trend is going down, you don't buy. Don't go against the market. Make sure that you follow the trend and keep your eyes on the news as well. That's it. Thank you guys, and I will see you in the next webinar.